Hey everybody, welcome to Market Mavericks. It is Thursday, 3 p.m., and we're back to discuss all the craziness in the market, including the macro and the micro, including the S&P 500 hitting a new all-time high, NASDAQ as well. Oil still around 90, and the Strait of Hormuz is still closed and with a blockade. But somehow the markets are ignoring it and racing to the highs. And I'm curious what these two gentlemen, Scott Melker and Mike McGlone, have to say about that. I mean, what the heck, guys? Listen, bounces occur. I'm in the markets. I trade bounces. Did I think that in 2 weeks we would go from being down 10% on the S&P to new all-time highs just that easily? I did not. I'd love to hear you guys' point. I mean, Scott, you want to start out? I mean, what's going on here?
Sure. I mean, you take a look at the S&P chart, which is just astounding, and you have effectively one of the best 10-day runs, I believe, ever. I think I read that it was in the top 99.7% of 10-day periods. I mean, this is a massive statistical anomaly. You see that huge gap up that cleared multiple levels and then straight to an all-time high. I mean, this is one of the quote-unquote greatest V-shaped recoveries of all time, and we didn't even dip that far. It feels like, I would say that the market is numb to risk, but it feels like we're numb to everything and have just gone to our default OS setting of only up. And I don't understand it. And listen, I'm here for it because I own assets and it's been good, but it doesn't mean I'm really excited to like buy the breakout on the S&P right now, like maybe you would in certain other markets, right? People love blue sky breakouts, looking up ahead. This is not the kind where I'm thinking, man, I can't wait to pile in. I was just waiting for a new all-time high break.
Yeah, and I think that's what is driving me kind of crazy a little bit is that, I mean, you look at the underlying macro data. I mean, the labor market's basically not growing, right? It's not like we're dropping jobs massively, but we're certainly not growing. Then you throw in inflation, which was already elevated well above 2%, what the Fed is trying to get to. And then you throw in $100 oil or 120 or 90, wherever it is now. And the market's just saying, or investors are saying, who cares? Markets are always going to go up no matter what. Buy every dip. What the heck, Mike? Tell us what's going on here.
Well, that's the first one I want to ask you, Garrett, a question. If that's the case, what you have some key positions you're looking at and thinking?
I mean, I'm pretty heavily, I will say the last couple of days I've shorted this market hard. So I'm basically all out of longs. When we were down the other day, I was or about a week and a half ago, I was buying software stocks because I was just like, man, these valuations are just ridiculous. But at this point, I've pretty much exited all my software names, great gains. But now I'm shorting the market, including the semiconductors, which you'd think there's a top in some of these names, and then they just blast even higher. So, you know, again, I'm here wondering from you guys, like, how do you make sense of this? Like, is this just psychology where people have been programmed to just say, hey, the markets will always go up? Look at a year ago, by the way, exactly a year ago. That's what happened. It went up for most of the rest of the year.
Well, I got that same, as my son would say, I'm confuzzled. But I want to show you a few charts because I figured, remember last year we dropped like 20% around this time and then had the sharpest rally ever. And then this year was 10% and had the sharpest recovery like ever. I want to show you my confuzzlement. So I'm going to go through just a few charts and show you. So if you're bullish copper, you got to be bullish the stock market. So first I'm starting with copper, the S&P 500, and Chinese government bond yields, all on the same scale. Just take copper per pounds. S&P 500 divide by 1,000, and you've got the same price. It was all the same price in 2020, but now you see copper just lagging the S&P 500. So my problem with this as a commodity strategist is the crocodile jaws. Does copper follow the stock market, or does it follow deflationary forces in China? And I look at it this is, I can't be bullish copper unless I'm bullish the stock market. I tell that to people, they look like I have three heads. Like, I'm sorry, that's just the way it is. Same with Bitcoin. Bitcoin's hovering at the 75,000 level. We all know it's good resistance, which is in a normal market. It's supposed to, people who like to trade, and I used to, you're supposed to get short, rip your face off, and then go down. But it's hovering there. I just, as an ex-trader, I know what had happened if I got short there. But I want to show you the key theme I'm thinking about Bitcoin. It's the same thing. If the stock market goes up, yeah, Bitcoin will go up. I'm just worried when, at some point when stock market goes down, that's what Bitcoin's waiting for. But at the same time, I also point out the key theme I have in themes like Bitcoin when I point out the whole space had its run. It had its run up to this peak and the biggest money pump in history. This is the market Market Vectors 100 small cap index. The correlation between Bitcoin and that index is the highest ever, almost 0.90. It's a key point I want to make is this is just a space with unlimited supply. Bitcoin is the first, it's special, but the point is if the whole space is going down, Bitcoin's got a problem. And I just want to show you a few other charts. I'm good. So I'm looking at the Bitcoin 60,000 to 75,000. The key theme now is if we ever close below 60,000, that's the end for everything, because that was the high when we had the biggest money pump in history. And that's the key point I like to point out is that's when crypto started underperforming risk assets. They're supposed to go up in that environment, but they did. And then I just point out, if you go back to 2017, that's a significant year because that's when ETFs, I'm sorry, not ETFs, but futures first started trading in Bitcoin. You look at S&P 500 total return, it's up like 180%. You look at the Bitcoin crypto index, it's already ticking down. It's up less than that. I mean, that's not a good sign. And then the price of all metals index, all about the same. So I just want to tilt over to crude oil and show you the key theme I'm thinking in crude oil. It's this December contract, that's the one that matters. It's hovering right between, it's like 76 now. The front's 93. That May contract is going to go off the board next Tuesday, I think, and it's going to just pop down to June. So we have this inordinate burden for these contracts to ride higher. And I fully expect that $76 to be closer to 50 than 100 by midterms. Now, you've heard that from me before, but what does Mr. Trump want? But I want to show you two key themes, and then I'll stop there. This is a chart of the Bloomberg Commodity Energy Index. It's got spot index, so spot prices. It right now is potentially backing down from the same price as 2005. Key theme to remember about energy commodities, particularly, this is overlaid with Brent crude oil, is they go down because they went up, and they just went up a lot. Why? What happened? You bring on that supply, you curtail demand, you break things, and you go back down. But how do you get excited about a market that's unchanged for 20 years? That's the spot prices. But I want to show you a key thing that goes up, metals. The problem I have as commodity strategist, this is just showing gold. I have copper. I have the Bloomberg All Metals Index overlaid with the S&P 500. It's all the same trade. So if you're looking at a value risk model, if you long any of these or short anything, it's all the same thing. But I'll end with this. So one thing you ever want to be long in, if you're bullish commodities or in this space, is the companies that create the commodities, because this is just the XLE, the State Street Energy ETF, from a base of 100 like 2003. It's close to 1,000 now, so it's up 10x. So that's the key thing to remember is there's a bull market in elasticity. When people get bullish crude oil at the highs, like to say, is what are you missing about the trending elasticity? It's the ability for people to create more with less and make profits doing it. Now that's the part of trade you want to be on. So I just show the equities. Now they've done great, and also what does Mr. Trump want? He wants the companies to make money, energy prices to be lower by midterms. I think he's going to get it.
But I guess, I mean, and Scott, I'm curious about your views on this. Is like, how many times have we said, oh yeah, the market should top out here and we should actually be heading lower? And then every time. So if you're a retail investor, right, like everyone watching here probably is, what does it even matter what the data is anymore? I mean, does it even matter? It just, how do you even react? Because if you're a retail investor and you look at the data, you're like, yeah, this market's probably, I shouldn't be buying. And then it just rips up 12% in 10 days.
I mean, how long have we been doing this show? Because every signal has said that everything should go down since we started. I don't know how many years ago that was. I remember I was having conversations when Bitcoin was below 20,000, right? I mean, and all the data seemed to point to new lows. So I find it almost impossible to parse the data. I find it hard to even believe a lot of the data, to be quite frank, not as a conspiracy theorist, but we know that things like job data and inflation are effectively cooked. And even if they're not, it's expectation versus actual and not what the actual data means, to the broader market. So I just find it, as I've kind of said the whole time, I just ride the wave until proven otherwise. I guess it hasn't broken below the key levels where we get scared. But I mean, this last one is just even more mind-boggling than the bounces of the past. I mean, this is effectively the largest round trip, call it down 10%, and, recapturing the level it fell from. Pretty much, I looked it up. I mean, it couldn't find one that was more. Even like Volmageddon, in 2018 and all these others, they took weeks to recover. I can't figure it out. I don't know.
Do you guys think this has more to do with how much money is in the system than anything else? Like, I mean, is that investors, right? And you're looking at something and you're saying, wow, inflation's going up. I can't just sit in cash because I'm going to just lose money. So, like, we know this market generally makes new all-time highs. Just throw it all in, lever up, and go with it. Or maybe zero-day options. I mean, people
I
just
mean,
buying these zero-day options, causing
they,
the institutions to buy the markets in the underbelly. I don't know.
yeah, I don't know, because if inflation's going up, we're supposed to expect tightening conditions, right? So it just doesn't. I don't know where all the money's coming from. To answer your question, I don't feel like when you talk to your average person, they're flush with cash, right? So it's
No.
clearly institutional or the exceptionally wealthy, and I feel like the exceptionally wealthy were already in the market, and how are they possibly buying at these levels? Like, I can't find people anywhere, even my friends who are on Wall Street, who are excited to buy. Who's
Yeah.
buying?
The only thing I did hear, Mike, and you might know more about this, but I did hear that when we were at the trough of this drawdown, hedge funds were heavily out of the market, and so they might be playing that catch-up game. And just to remind everyone, everyone looks at hedge funds as being like, "Wow, they're a hedge fund." But Mike, you probably know this as well, is that most hedge funds are like John Q. Publics. They're not the greatest. I mean, yes, you have the David Teppers of the world, the great ones, but a majority of them, it's about how much money you can raise, not how good of an investor you are as when you start a hedge fund, right?
Well, there you go. I think most of them are now responsive algorithm, bot-driven type mechanisms, and we all know what happens. It's ingrained. VIX got to 30, stock market down 10%. Algorithm kick in, must buy, regardless of why. Prove us wrong, and it works. It'll keep working until it stops working, and that's when it'll be the big one. I keep thinking it's the big one. Wrong. But the key thing is we've had some pretty significant early warnings, like what the volatility that we have, that exponential, the surging volatility in gold and surging volatility in crude oil. We've never had that with stock market volatility hovering this low. Now that's starting to pick up a little bit, but the indications are there. And the key thing is cryptos. I mean, they led the way up, they're leading the way down. That's why I keep fixating on cryptos. Okay, please show some strength. But then I look at the whole space and I'm like, yeah, okay, Bitcoin might be special and different, but it still has that whole space that is just still needs a purge. The purge is probably started. You get that stuff taken out that really, there's millions of them that track nothing. Get that out, and then you probably have a trout to buy. I just don't think it's there yet, but it's happening in all markets. Like, the key theme I really enjoy hearing is when people isolate one market, they're all together now. You look at people pointing out what's happening in energy and crude oil, that backward, those curves are lower, those futures are lower on backwardation, and that's going to go up. And I'm like, well, okay, well, how about corn and soybeans and wheat and natural gas? They're all the same thing. It's because what's markets, I think, understanding is, certainly in commodities, they go down because they went up. Cryptos go down because they went up. And the only one that really stays up over time typically has been gold and metals, and they went up too much. But at some day, it's going to be the stock market. And that's why the key theme I'm still sticking on this year is I'm watching that bond, that 30-year yield. It just can't stay above 5%. Every time it does, I'd love to just be able to invest in more, because I'm not a trader, but just like to get that 5 handle on there, because I think it's at some point when we get that normalization in the stock market, it's going to go to 3. Been wrong forever. I admit that, but it's the stage now that it's just so easy that when it's that easy, you have to back off. And the question is, how long is it going to stay easy to just buy the dip? But hey, the bottom line is, we are at the point, the stock market is the economy. It's going to be all that matters. The next recession will be driven by wealth reversion, and we're not getting that yet.
Shouldn't we be
Yeah.
getting demand destruction with the oil prices being so
Yeah,
high?
absolutely. Yeah. And it's not mattering yet. But look at Europe. I was just on a call with a guy from Amsterdam about an hour ago, pointing out how gasoline prices have spiked. And one thing they have there is you can buy all over. You can buy cheap Chinese EVs. You can't in this country. Why? Because they're 100% tariffs. Why? Because we have to protect our domestic manufacturers that are still making, compared to those cheap EVs out of China, essentially making buggies. But the rest of the world are getting these. So what's that going to do eventually to, look what's happened in Germany. Their GDP has been stuck forever. So I look at this as a bit of a historical distortion. I see what's happening in markets are warning us. Gold warned us last year what was happening, and now that's too expensive. And this, to me, I still stick with the key theme that I've been wrong on this year, and that stock market picking up, volatility picking up, and that S&P 500 total return up 3% has proven me wrong. But some of these levels we're looking at have still been holding. Like Bitcoin's high in the year was around 96,000, low is 60. I think by the end of the year, we're going to take out that 60. Yeah, a lot of people disagree with that, but that's going to be one key theme's driving everything. Stock market.
Yeah.
It's got to stay up for almost every market I watch to stay up.
So, Scott, turning to Bitcoin, we've obviously seen a bounce in Bitcoin, but I mean, compared to the stock market, it's non-existent. And I guess the question is, where are you standing, or what are your thoughts on Bitcoin at this point?
Well, it's a bigger bounce than the stock market by percentage, obviously, right? Because I think in that same kind of period, we went from the mid 60s up to about 75. So
Right.
it was a pretty nice bounce, but it's not like it's bouncing to all-time highs, to your point, right? So the S&P pulled a 10% dip from the high and broke out. We're still here, 40 something percent down from all-time highs. I think we're at a very key level right now. Like, I've literally removed every line from my chart except for that one, right? Because you have the one obviously back to the 74 area, which was the tariff lows and the previous all-time high from earlier in the cycle. But right now you've got this March high that needs to be taken out right around 76, right? I think 75 is a nice round psychological level. So let's just call it this area between 74 and 76. We just need to see real action. I mean, take a look at that candle where it tapped 76. That's a big wick up there, kind of a big increase in volume. So, maybe we consolidate and break out above. I will tell you there's some interesting data behind it if you're not just looking at charts for reasons that this could happen. Whale Wallet's actually accumulated 270,000 Bitcoin in the past 30 days. And these are the same wallets that were selling all the way down from 126. That's the most since 2013 from large buyers in a 30-day period. So if we want to call them smart money, we can say that they're definitely accumulating. This one may be a little less compelling, but still important. Supply of Bitcoin on exchanges right now is the lowest since 2017. So if there is a big demand spike and nobody else deposits a whole bunch of Bitcoin to sell, we do have some low supply there. And so there's just kind of a lot of these interesting little metrics right now that have mattered in the past. Oh, the other one was that we have exceptionally low negative funding rates, which never last long on perps. You usually get a short squeeze. So having low funding rates at this level obviously means that the crowd is willing to pay a premium to be short, and that's usually an opportunity. So maybe that could give us a break. The thing is, like, even you guys will understand, right? We go above 75. If we break to 80, 82, 83, that's a great move. And that's nothing when you look at it being a lower high in the market in general. We need to go so much higher for this to be convincingly a new breakout.
Yeah, in fact, I was just looking at this chart here, and I still actually think there is upside. You can see how the lower trend line and the upper trend lines, it marks literally a perfect parallel here. And what's interesting is that high end is right around 80,000, which happens to be our low pivot on the chart going back to this dip here as well. And you can see how those two lines meeting right out here, let's say by the 20th of April or so. And so I agree with you. If you look at Fear and Greed Index, the stocks one was way down in extreme fear, and it's now neutral, getting towards bullish. And same thing, metals have never really gotten to extreme fear here, gold or silver. But Bitcoin has been stuck in fear, and it's still in fear. And it does make sense that a short squeeze you could be due for it, as investors maybe rotate some of their gains out of the stock market into kind of a left behind asset. And that does happen. Yeah. Interesting. All right, Mike. So talk to me about the metals. Let's hear where you are on the metals in terms of gold and silver. You're still obviously very bearish, thinking there's further downside that the tops are in.
Yeah, and in fact, that was what this is like all metals index. The key theme is at the end of February, all metals index, Bloomberg all metals index, which I was lucky enough to ask the index team to create 10 years ago. Just a simple idea of, if you're going to invest in any commodities, invest the ones that go up and stay up and are easy to store, and electrification, decarbonization, everything. But at some point you reach too high levels. And what's the key thing to remember is any supply demand price on the left. When price moves exponential, that supply demand stuff is very much lagging, but you have to adjust mentally and forward what it's going to do for the elasticity that supply and demand, and it almost always signals the peak. So the velocity of the rally we had in gold, the highest in 40 years versus a basket of treasuries, the highest ever versus the Bloomberg Commodity Index, the highest in 4 decades versus its 60-month moving average and most moving averages, is a clear classic case to sell. The key thing is when you get to a crowd of people, which I love going to conferences, that's when they all get excited and they get mad at you when you say the opposite of what you said the last 10 years to buy. And that's when you know it's pretty much the key. So I fully think the range for gold for the next potential decade can be between 3,000 and 6,000. It's going to get everybody bullish on the highs, get everybody bearish on the lows, and it just run its course. It front run all the stuff you talk about, debasement and everything. Silver too. The silver is an industrial metal, and remember, it is the number one thing for electricity and decarbonization and electrification and everything, but it's already run up too far. And every time it goes up at this velocity, particularly when it reached the highest ever versus copper and crude oil in January, it always makes highs that last for decades. So for copper, for silver, I think we're stuck between maybe a little bit of above 100 and maybe down to 35. At least 50 is good support for a decade. It's going to get you bullish on the highs and bearish on the lows and just underperform what it did last year. It just goes up on a step, it goes too far, shifts all the bounces, and then just hangs out and goes down for a while. And that's the same thing I think about Bitcoin. It's going to get you bullish near the highs and bearish near the lows and eventually go down. But the bottom line for all these things now, all metals and Bitcoins, is they are most dependent I've ever seen on a rising tide from beta. Stock market hosts to go up. And that's a key thing that shifted in gold. Gold, 180-day volatility still right now is about 2.3 times S&P 500. Typically, it runs a fraction. It runs below the S&P 500. So when it shifts like that, that's the highest since 2009. That's a signal that it's a speculative risk asset. It's much more likely to trade with the stock market than against it, which is not what you want and is a hedge. So also, I think the metals have run their course, and gold's just one of the gaggle now, one of the doves. That's the big difference. So there's only 10 major metals that matter, but they're the doves I started using last year. But Bitcoin and cryptos, they're pigeons. There's so many of them. I can't, that's the problem. At least there's one major significant dove, and that's Bitcoin, but the rest of them are all just a bunch of pigeons against the doves of the metals. The doves just flew too high.
So one thing just to point out on the market today, I was just looking, is so if you go back a week, we saw the S&P trading tick for tick inversely to oil, right? But what's interesting is that today the S&P's up and oil's up as well. Oil's up about 3%. And so I do wonder if people have gotten this, so initially it was a very much regimented trade where it was algorithmic, probably buy S&P, sell oil. But with both of them being up, I do think this is where the animal spirits start taking over, right? We know retail tends to buy at the higher levels. And I wonder if you're just seeing people piling in, afraid to miss that rally, that rally that seems to happen every time. It just keeps going and going and going.
Well, that might be one for you, Scott. We know how, that's a wonderful thing about what we do in business is human nature will never change. People get really bullish when they shouldn't be, get really bearish when they shouldn't be. And here's the thing I'm working out. Now we're April. We've had a decent trading year, and it's only 4 months. And we're heading towards the doldrum months. And I think it's just going to rip people apart. It's going to be great to be, I think, more of a responsive trader. Sell when it goes up, buy when it goes down, and buy it. I mean, almost everything, because they're all linked now. And then at some point, we're going to hash this out. But the key theme to remember about oil is it breaks stuff when it goes up a lot. You saw that this year. I think 120 is going to be the high for a long time. As you can see, my view is it's going to head back towards 50. But it's that elasticity, is the amount of supply that's coming out of the U.S., the amount of demand destruction. Just having diesel near its all-time high in this country and spiking in Europe. But one thing that's, as I pointed out earlier, the producers are loving this. Just bring it on. Let me hedge forward. And I'll end with one story. I remember the first time I went to Texas was in 1986, and I was accountant for a travel agency, but I got into the oil business a little bit. I remember that was a down cycle. Gas and crude, the price of gasoline had dropped in near 10 after peaking near 30 during that Iran-Iraq war. That was a downward cycle. What's happened in this, we always get cycles. We had a pretty good cycle to that peak in 2022, and we just stalled. We're just starting to get to that low price cure around $55 a barrel, and we just spiked it. It's going to extend the cycle and make it go down more. That's the problem with what usually happens. Why? I'll end with this. Why is natural gas down 27% on the year? Because it was up 100% in the beginning of the year. It incentivized all that demand, squashed a little, or supply, squashed a little demand, rinse and repeat, goes back down. That's what happens with elastic commodities when we enter a world with rapidly advancing technology, replacing and being able to bring on supply and curtail demand.
So one thing just to turn us back towards, and I want to get Scott's input on this, is that, I mean, I just brought up on my screen this chart of Solana, and it looks like it's just about to blast. I mean, look at this wedge breakout, bullish consolidation, and now it's trading above the recent highs. I was curious if you're looking at altcoins potentially. I mean, again, not the crap coins, but the better ones, the Solanas, the ETHs. And your thoughts on these charts. Are they charts that could pop here?
I did find it interesting that earlier this week, when Bitcoin made a move up, ETH actually dramatically outperformed. I don't know if that was a function of Bitmine, of Tom Lee buying that day, or what exactly happened that day. But we have seen for the first time in quite a while, at least, most of these large name altcoins keeping up, which I think is generally, a decent sign. I mean, you can see XRP. I think they had some news in Korea or something, but XRP, Solana, as you said, they're up 4% while Bitcoin is effectively flat. It's an encouraging sign. I don't think they're going anywhere unless Bitcoin convincingly breaks above those levels that we were talking about and holds there, right? And I think that then there will be a bit more excitement. But I would say that these kind of larger cap altcoins moving maybe is a sign of broader risk on that we're seeing in other markets as well. I think people are just perfectly happy to buy whatever right now.
Yeah, and that's kind of so I'm leaning towards that too. I mean, when you see the market ripping like this to all-time highs this quickly, I mean, if I'm just a retail investor, I would be thinking, well, okay, I didn't catch that, but what hasn't ripped yet, right? I mean, there's this kind of cycle through. The other thing too to keep in mind, if we look at, like, here's Oracle, right? So these software stocks, and you could argue a lot of altcoins kind of are software-ish, right? I mean, and now all of a sudden Oracle's just gone up from $135 to $180 in a matter of 3 or 4 days. And now we're seeing these kind of altcoins starting to catch a bid as a second tier kind of maybe software play. So, it's interesting here. I mean, there could be some money to be made in some of these. I was looking at Avalanche as well. I mean, and again, it's not to say I have any of these or whatnot, but again, these charts are finally looking a little bit better, like they could run. I think it's important to caveat this with that. I don't think any of us here think these are going back to all-time highs. It's more like a 20, 30% bounce is doable, but then probably at some point, everything's going back down again.
Well, I have to stick with that. And you mentioned ETH. Can I just show you one chart on ETH? The theme that this has always been my theme when I started trading in the pits is used to be called market profile. It's a normal distribution. We're approaching 2.5 years of trading in ETH now. That's just a pure random walk. And where's the mode? The high volume price is right around 2,500. So I look at it as you rotate to the upper end of the range. Everybody gets bullish around 4,500. Rotate to the lower end of the range, which has been 2,000 so far. And the first move up should be around 2,500. You're supposed to. That's the first level to look to. Okay, if it can stay above that level, we're good. It rotates back up. But to me, that's the first level. You're supposed to be a responsive short. Make it prove strength. And that's what I'm looking at. Still looking at ETH around 2,500. It's basically the high volume price for the last 2 years. It's got to stay above that level. Otherwise, I think it rotates back down, gets somebody bearish around 1,500, and then goes back up. But just a little technical lesson learned from trading bell curves.
Yeah, super, super interesting. We only have a minute or so left, and I want to bring up this chart because it's a chart I've talked about with you guys before. Let me do that now. This is the S&P 500, right? And we've been in this uptrend of a parallel from COVID low, bear market lows, liberation sell-off lows. Bull market high is right at the high end. And you can see earlier this year or late last year, earlier this year, we kind of tagged the upper end of that parallel. We then got a sell-off. Look at where the selling took us, right to the midpoint of that channel. And now we're shooting up. And so just as a technician, I'm saying, okay, well, we look for that hit right there again, and that could be the rejection point. At this point, that's only about 1.5% of upside in the S&P before we slam into that upper trend line that has, again, been intact for 6+ years. So it's going to be interesting. I'm curious next Market Mavericks, when we're back on, wherever we are. Did we hit that? Did we pull back? Did we blow through it? And then likewise, do we see these altcoins maybe rip over the next few days? Be interesting to see. All right, guys. Any final thoughts?
Just one thought. There was a guy I saw last week at a conference. I see him every year at the Money Show. His name's Tony. Here's to you, Tony. He says, Garrett, you're one of the best traders on the planet. And that chart just is emphasized. But my pattern recognition spidey senses that I learned from you, Scott, from that chart is we've had, that bottom last year left a good gap on the way back up, I mean, free money. And the bottom this year left a good gap on the way back. That's 2 in a row now. That's the kind of stuff where you make enduring peaks. I think when you get everybody thinking it's never going back down, every time it's those gaps, they're signaling that, yeah, okay, McGlone's been saying that forever, but oh well, maybe at some point I'll be right.
All right. Well, I have a feeling we're due, and the scary thing is that I was looking up was there this FOMO type of feeling in the 1920s? And again, it obviously wasn't called that back then, but there was a very similar kind of rush for buy every dip back then. And again, it doesn't mean it's tomorrow or next year even, but I do think it's important for us as just investors as a whole to recognize things that are repeating in human psychology and what it can lead us up to in terms of a final flush out, if you will, kind of like that. So, all right, guys, thank you so much. Awesome episode today. Please follow these gentlemen below on their handles there on X. And as always, we'll see you guys next Thursday at 3 p.m. Eastern time. Take care.